Good day, ladies and gentlemen, and welcome to the SOFTRAX Executive Webcast Conference Call. My name is Anita, and I'll be your operator for today. At this time, all participants are in listen-only mode. If at any time during the call you require assistance, please press *0, and an operator will be happy to assist you. I would now like to turn the call over to Bob O'Connor, President and CEO of SOFTRAX Corporation. Please proceed.
Thank you very much, and welcome everyone to today's webcast. SOFTRAX is the leading provider of revenue management solutions to hundreds of companies, and many of whom join us on the call today. We have over 1,000 registrants for today's webcast, which indicates how much executives want to hear about today's topic from our distinguished speaker, Dr. Tony Sondhi, who is backed by popular demand to make his presentation entitled A New Revenue Recognition Standard, where Tony will be focused on the FASB and IASB discussion paper. And as always, Tony will be available for questions at the conclusion of his prepared remarks. And I'd like to comment that this isn't the last time we're going to discuss this. I think thanks to Tony's work and his involvement in all this, we really get an early view of this and his interpretation of things and where things are headed. And we will be back at this as conditions warrant. So let me just go through our agenda for today. I'll spend just a few minutes talking about SOFTRAX and how we fit into today's topic. Then I'll turn it over to Tony, who, as I said, will give us an early look on the discussion paper. And for those of you who are unfamiliar with our webcast format, we do leave some time at the conclusion of the prepared remarks by Tony in this case to answer your questions. And all of this will be done by the top of the hour. So to ask a question, and you can ask a question at any time, in fact, we already have questions, so if you can ask questions at any time during the presentation, just by clicking on the Ask a Question feature, and I will be reading the questions throughout Tony's presentation, and we'll ask him towards the end of the scheduled time. And the most commonly asked question, and we already had this already, is can I get a copy of the slides? And the answer is yes, but we do make you work a little bit, probably for about a minute, but it's a very valuable minute for you and us. So when we finish the webcast, you will see a link to an online survey. We read these very carefully, and it's one of the reasons we have Tony on today, because this is a requested topic. That will allow you to get copies of the slides. It will allow you for an email, through email. It allows you for a link for a rebroadcast. It allows all attendees for CPE credits, one CPE credit, and also allows for your name to be entered to get a copy of the very important 2009 Revenue Recognition Guide, which Tony is a co-author, and we'll get those to 10 people. So as I said, a very valuable minute for you and us at the conclusion of the webcast. So let me just spend a few minutes on SOFTRAX. We developed enterprise software that manages all aspects of a company's revenue cycle. And throughout the U.S. and throughout the world, several hundred companies from many different industries use our software to manage their complex billing, revenue recognition, allocation, reporting, and forecasting, and many other functions. And as you may know, SOFTRAX started by serving the complex revenue needs of the software industry, where RevRec became more complex earlier on, and we are now the clear leaders in that market. And as you can see, we have grown to address the complex revenue needs of many different industries. When we look at the operating challenges that CFOs and their staffs and their finance teams are confronted with, they're across many lines. They certainly have many billing and operational challenges due to a proliferation of business models. They deal with complicated contracts with their customers, recurring issues, recurring revenue issues around subscriptions and maintenance and renewals, many different business models around bundling or perhaps on-demand or utilization offerings. In the middle, they're dealing with complicated and ongoing revenue recognition issues, as we'll discuss today. And on the right, you'll see that everyone is really under pressure to improve financial reporting and visibility. And these challenges create a lot of operational issues for CFOs and their teams. And accordingly, our applications are closely aligned with these challenges. We have billing and operational applications that do focus on contract and the recurring aspect of revenue in terms of renewals and order management and so forth. Really unparalleled revenue recognition capability for all types of issues that people are faced with regard to revenue recognition, and analytical applications that are needed to provide improved and increased visibility and help executives make strategic decisions. And all this functionality can be licensed individually or together as part of two main product offerings. The first being our billing scheduling and revenue management solution. Really is a very comprehensive application across many different industries. Our deep domain expertise over the years have allowed us, again, by dealing with hundreds of customers, to know the intricacies of the businesses listed on the top of your screen. And secondly, for larger enterprises who have already implemented or plan to implement an ERP application, our Revenue Manager application provides the really most robust functionality and is very complementary to existing ERP systems and provides great depth and functionality with regard to revenue recognition, allocation, forecasting, scheduling, and so forth. So our mission is to help our customers maximize their revenue into their customer base, reduce the operating costs that we see in terms of companies doing work very inefficiently, and all the while making sure they comply with the latest and greatest with regard to regulatory issues. And through our website, revenuerecognition.com and IDC, there is much useful information to share, and I'll just touch on a few of these. Due to the overuse of spreadsheets on critical financial functions, most financial professionals feel that their revenue accuracy is, in fact, hanging by a thread. And the reasons for such wide use of manual processes are reflected in many studies, and you really can't see them all here. I encourage you to go to revenuerecognition.com for the details of these studies. But at a high level, due to the business models, the transaction types, the volume of transactions, and regulatory oversight, revenue is the most difficult number to get right and to manage and to establish internal controls for. ERPs not only have a gap in this area, but are fundamentally not designed properly to manage revenue, complex revenue, from the beginning of the life cycle to the end. And obviously, doing these manually creates a good deal of problems and has a significant impact, and there's a great impact in terms of getting things wrong, including the issue of compliance, the risk of errors. The materiality of those errors with respect to revenue is critical. Many studies show that there are closing delays due to the complexity and volume of transactions, and over half of public companies are relying on broad assumptions around revenue rather than specific data and information. And the enterprise process is really a challenge for many companies, and that challenge fundamentally comes down to the fact that many industries, and the list is growing in terms of the number of industries, can't manage only the classic order-to-cash process that the ERP systems and generic financial applications are designed to manage. As early as the contract, as early as the order, there needs to be a parallel and integrated process to manage revenue. And over the past few years, due to increased regulation, the importance of managing this parallel track, and frankly the distance and the complexity between the two, has grown. However, we see companies who are trying to address the revenue issue with a host of disconnected manual or custom systems that create significant problems when one's trying to scale a company, run a worldwide enterprise, or acquire and integrate companies into their framework. So this challenge is growing. When we look at today's environment, we might be someday thankful that we only had to deal with U.S. Gaap and compliance issues, which frankly has been enough for all of us to digest over the period of the last few years. In an earlier webcast, and I'm sure many of you, that was a very well-attended webcast, I'm sure many of you joined us then, when Tony took a look at IFRS and talked about the looming issue of getting ready for IFRS and the historical information as well as the revenue infrastructure that's required to be ready for that. And as we look towards the future, which is really the topic of today's webcast from Tony, I think that you'll agree, Tony agrees, our customers and the industry generally agrees that these challenges will persist, become more complex, present ongoing operational and strategic challenges that require an underlying revenue management infrastructure to move forward. So with that, I'll conclude my opening remarks and welcome, as always, Tony Sondhi. Tony is currently a member of the EITF, the Emerging Issues Task Force. He's on their working group of 08-1 and 97-2. And the ITF is working for the FASB, the Financial Accounting Standard Board, its Agenda Committee, and its 2008 Working Committee. He's a member of the Expert Advisory Panel on Fair Value. I could go on and on. He's the co-author of the 2006 to 2009 editions of the Revenue Recognition Guide. As I mentioned, 10 attendees will be drawn out of a hat to get copies of that. Tony is also certainly a very valuable consultant to many companies around revenue recognition practices in software and contracting industries, multiple arrangements, and so forth. And later on, I hope Tony will share some of his events, upcoming events around the country where he can spend some time with each of you one-on-one. So welcome, Tony, as always, and it's a pleasure to have you here, and we're looking forward to your discussion.
Thank you, Bob. Thank you very much for the introduction and the invitation to work with you again on this. As you said, it's an interesting and complex topic, so let's get started given the amount of time. I'm sure, as you said also, you have already quite a few questions. I figured that there would be a few at least. So let me get to...
Usually they wait till you start, Tony. In this case, they're coming in early, so...
Yeah, I figured that would be the case. So let's take a look at what we've got over here. Now, I want to begin with this discussion paper, and I want to mention a few caveats as well. The first point, of course, is that last December, the FASB and the IASB issued this discussion paper titled Preliminary Views on Revenue Recognition in Contracts with Customers. Now, for a very long time, as the attendees at this webcast are aware of, the FASB and the IASB have been working on converging their standards. And in this process, they've certainly spent a fair amount of time on a certain number of selected issues where they've been developing the standards together. Acquisition accounting was one example. Now revenue recognition is another. The primary objective, of course, in the case of the revenue recognition project is to develop a single model that provides much better, much more consistent, clearer guidance on when entities should recognize revenues. And, of course, the objective, therefore, is to reduce the number of applicable standards. Anybody who's taken a look at this discussion paper, I'm sure, is aware, and anybody who's been working on these accounting issues is aware that revenue recognition comes in very many different forms. We have more than 100 accounting standards in the U.S. Now, there aren't as many, of course, at the IASB. In fact, we've got IAS 11 and IAS 18. But given the broad sort of principles-based nature of those standards, of course, they're expected to be applicable to at least as many industries as we have. There are a couple of things about this discussion paper that I want to point out before I get into further into the rationale for this paper and the timing and approach and all of that sort of thing. So the first thing that I want to mention, because I really want to encourage everybody on this call and people you work with to be very careful, review this discussion paper, and as I've noted at the bottom of the slide, it is open for public comment through June 19th, 2009. So I recommend that you review it, and I really encourage you to participate in this process and send your comments. You're working with these issues, so you're certainly very close to it, and your views matter a great deal. So I would recommend that very highly. Now, a couple of the other issues that I want to point out here. The rationale, as I said, is to try to develop a single accounting standard. And the objective really is to improve consistency for similar contracts. And that's whether you're working in insurance or in leasing or other. Now, it turns out, please keep in mind, that there are certain industries where the FASB and the IASB have not really applied the issues in this discussion paper. Financial instruments are one, leasing, et cetera. Insurance, for example, is another. But keeping that in mind, the idea here at least is to develop a revenue recognition standard that would apply regardless of the industry. And, of course, comparability and understanding of revenue for financial statement users is a very important concern here. And as you're all aware, if you've attended any one of my earlier webcasts, my perspective is certainly that of a user of the information provided by financial statements. So this accounting standard is certainly an absolutely critical one from that perspective, and this proposal, therefore, is a very important one. Now, let me tell you a little bit about timing. The boards expect to release an exposure draft in 2010. They do not expect to have a final standard before 2011, and with an effective date no later than 2012. Now, those of you who are fans of financial reporting standards, users of financial reporting standards, you may have noticed that it does take the boards some time to develop standards. So I would suggest that I think this is fairly ambitious timing. I hope they can do it. I wish them well, but at the same time, it's going to be very difficult. There are a few accounting standards that I think are as difficult as revenue recognition is. Consolidation, for example, is one that comes to mind. And the boards have spent a lot of time working on consolidation, and it's not yet clear as to where we're going with respect to that. So I think that although these are certainly laudable objectives, you should be aware of the fact that this may not quite work out according to this time schedule. Okay. Now, why do we need to do this? As I said, of course, at the start, we've got a lot of different accounting standards. They're inconsistent, and that's one of the major reasons. Other reasons, which I think in part at least Bob has already mentioned, please keep in mind, for example, that revenue recognition is one of the issues that, probably the primary issue that people have problems with, restatements. It accounts for a majority of restatements. It has always accounted for a majority of restatements. So from that perspective, it's certainly important that the boards develop clearer, more consistent accounting standards. Now let me go back and just remind you briefly, although I suspect nobody really needs reminding, that what we do today is we recognize revenue in terms of the completion of the earnings process and the realizability of the payments. So the current accounting standard on revenue recognition, its basic principle is designed to answer two questions. When can you recognize revenue, and how much revenue can you recognize? Now, over the years, the fact that different accounting standards have been developed for different industries, the fact that different bodies have developed accounting standards. Remember, there are some revenue recognition standards that have come from the FASB, the others that came from the ACSEC, the committee of the AICPA, that used to develop SOPs. Primary example is the revenue recognition standard for software that we all know and love. Now, when you think about that, you're also, those of you who are interested in revenue recognition, are aware of the change that was brought to revenue recognition by the issuance of the Staff Accounting Bulletin 104. Now, here's a very good example of the fact that earnings process has been inconsistently defined. The discussion paper uses the example of FAS 51, which deals with the cable industry, and in SAB 104, where they deal with telecommunications. And it's a great example of the difference, because in one case, connection fees, which are comparable to the non-refundable activation fees, the accounting treatment of that is quite different. In one case, we recognize it as revenues. In the other case, we do not. So the earnings process, the ambiguity with which it is defined has led to significant problems, the discussion paper tells us. Then, as I've noted, there are some significant gaps in Gaap itself. For example, we don't really have an accounting standard on service transactions. Now, I'm aware that we have an invitation to comment, but that doesn't qualify as an accounting standard. Of course, the problem is that there's very little out there, if anything, on service transactions. You may find some implementation guidance in SAB 104, but you're not going to find an accounting standard on service So many people, of course, look to that invitation to comment. The IFRS, for example, does not really do very much with multiple deliverables. And I must say that that's one of the things that I've always thought about because, as you and I are aware, there are very few transactions these days that do not involve multiple deliverables. Everybody's interested in offering solutions rather than single products or single deliverables, and that approach to offering solutions, of course, brings us to multiple deliverables. And as you're all aware, the accounting for multiple deliverables is quite difficult. EITF 0021, as it may be amended by EITF 0801, is something that we're all aware of, and yet, as you know, the IFRS does not have anything on that issue. So certainly consistency and comparability suffers as a result. There's, of course, also, as the discussion paper points out, in the IFRS sort of ambiguity with respect to at least the distinction between goods and services. And as you know, we certainly in the U.S. work very much in terms of the distinction between those two. Now, a few other issues that I'd like to mention. Again, in IAS 11 and IAS 18, there's an inconsistency in the way we think about performance versus transfer. And as you're going to see in a few minutes, this discussion paper certainly spends a great deal of time on that issue. Now, the earnings process approach in the U.S. GAAP, the risks and rewards of ownership approach in IFRS, the discussion paper tells us has often led to misrepresentation of contractual rights and obligations. In other words, when assets and liabilities arise, how they change over time, and therefore how they affect revenue recognition. Those are all very significant problems and are the reasons why the boards undertook this project, and in a sense, of course, these are the reasons that guide the approach that's offered in this discussion paper. Now, let's take a look at what the boards have proposed in this and what they're talking about in this paper. The first thing is, very importantly, that in keeping with the approach that they've used elsewhere over the last 2, 3, or 4, or 5 years in the financial reporting standards, there's a focus here on the asset liability approach. So we're going to move away, in a sense, then, from the earnings process approach to the asset liability approach. And the focus in this asset liability approach is on an entity's contract with its customers. So it's the contracts that are the driver of revenue recognition in this case. Now, there's a presumption, I think, in this paper that permeates this paper, and that presumption is that an asset liability approach is going to generate a more consistent application than the imprecision, I guess, that we had in the earnings process approach. Now, the discussion paper does tell us that they do expect the answers to be similar in many cases, and yet there are some very important cases where they're not going to be similar, and there will be differences. And I think that's why I've chosen to characterize it as a presumption that the asset liability approach will provide more consistent answers. It's not clear to me that that's going to be the case, right? So we'll have to take a look at it. Of course, I do understand that this is a preliminary discussion paper and therefore sort of the first step in the entire process. And yet, as I said, it's important to keep in mind that there's this presumption that the asset liability approach would be better. Now, let's take a look at what's been proposed and what's discussed in this paper. Basic idea is that, as I said, it focuses on the contract. Now, therefore, the definition of a contract is going to be critical. The paper tells us that a contract is effectively, or in essence, I should say, an agreement between two or more parties that creates enforceable obligations. And I think what we need to think about and what we ought to focus on is that the concept of the enforceable obligation. So it's very clear that it doesn't have to be in writing, because if customary practice for an entity in its activities, in its transactions with its customers, if those practices give rise to enforceable obligations, then that would also imply a contract. In certain circumstances, it might be local laws that would imply the existence of enforceable obligations, in which case that also would qualify. So please keep in mind that it doesn't have to be in writing. It could be a result of practice, could be a result of laws. For those of you who are familiar with SAB 104, you may see echoes of SAB 104 in this argument. Now, the next point, of course, that I think is very critical is to think about the definition, the proposed definition of a customer. And again, going back to the paper, the idea is that a customer is a party that has contracted with an entity to obtain an asset. Now, that asset is broadly defined, and therefore it could be goods or services. Now, please keep in mind, we've already noted that there is a problem, an inconsistency at least, in terms of the definition of goods and services. Right? But keeping that in mind, the idea here is that a customer is a party that has contracted with an entity to obtain an asset, and that asset represents an output of the entity's ordinary activities. Now, I want to just clarify what ordinary activities are, because if you've been focusing only on U.S. Gaap, then you may not have seen the same, although I doubt it. But let's say, just to be clear, I think the concept here is quite similar to what we think about in the U.S. as ongoing major or central operations. So the output of the ongoing major or central operations of an entity would be effectively the same as the ordinary activities. Now, for those of you who are familiar with U.S. Gaap and the projects that the FASB and the IASB have on hand, I will just remind you that there are similar issues in the financial statement presentation project, which is something that's very, very important, and you ought to be very clear about where the boards are going on on that particular project as well. And that's where the issue of ordinary activities, ongoing major central operations is going to be very critical. Now, just as an aside, I wanted to mention something else, which is not discussed, and there's no problem with that because I think it's something that comes down the road a little bit. I've always been fascinated by the idea of this issue as well, because you see, you could have a customer who contracts with an entity, not in a normal contract as we understand it, to buy a product, but a contract which is really what we think of as, say, a futures contract. And if you have a futures contract where an entity agrees to deliver, let's say, the output of its ordinary activities, then should that count as revenue? And clearly that's going to be a very, very important question to keep in mind as we go through this. Now, the way this is structured, the paper says that it's the combination of and the relationship between the rights and obligations that result from a contract, and that combination of rights and obligations will give rise to the net position in the contract. That net position could be an asset, and that'll happen when the rights of the entity exceed its obligations, or the contract from the perspective of the entity would be in a liability position when the obligations exceed the rights. Right? Now, the unit of account, therefore, proposed here is the net position that results from all the remaining rights and obligations at a given point in time. Now, what I thought was very interesting here is that, of course, the unit of account is considered contract, or it says a group of contracts if they're deemed related. The discussion paper, however, has not addressed the concept of related, or what we normally think of as linkage. And as you're all aware, that is a rather significant issue in revenue recognition. So I think that one of the areas that I would like to see further development, and I think it's important to do it at this stage, is the concept of related or linkage between groups of contracts and how that would affect revenue recognition. In fact, when you read through the discussion paper, there are many places, several places, where you will find the concept of linkage or related would affect the answer that you come up with. So in a sense, I thought it would have been very helpful to have more of a discussion of related in this paper. And just a little bit more on this issue of net position. So I've given you here on this slide from the perspective of the customer. Say, for example, the customer makes a payment. At that point, the net contract position decreases, the contract asset declines, liability increases. If you look at it from the perspective of what happens when an entity provides goods and services, in other words, it reduces its remaining obligations, its net contract position increases. And that increase is what the entity would use to recognize revenue. Right? Now, please keep in mind that payment by a customer will not result in revenue recognition. What we're looking for here is the impact of performance on the obligations. So it's the issue of, for example, reduction in the obligations. So as you perform on the obligations, there's a reduction in those obligations, and that's the trigger with respect to revenue recognition. Now, I'll come back a little bit to talk about this payment issue, because I think it's quite important and how it affects and what impact it has. So the fundamental revenue recognition principle that's been articulated in this paper then is that in a contract with a customer, an entity will recognize revenue when the asset increases, the contract asset, I should be more precise, or a contract liability decreases, or there is some combination of the two. Now, there's a very important exception to this, and that's the condition under which there'll have to be a remeasurement. And that's a concept of what happens to the remaining performance obligations and how that's affected. So let's hold that aside for a moment, but I do want you to be aware that there's an exception to this which occurs when there's remeasurement. A little bit more then on the performance obligation. So please keep in mind that you may have already noticed this if you've taken a look at the discussion paper or even just the preceding discussion that we've had so far. Please keep in mind that the performance obligation is quite similar to the concept of a deliverable. And as I've also said at times, either in the past webcast discussions or in my writings, one way to think about a deliverable is to think of it as being somewhat similar to an earnings process. Right? So that's why I said earlier that it is expected that we'll have similar answers, but hopefully more consistent answers when we move to an asset liability approach from the earnings process approach that we have at the moment. Now, keeping that in mind, the performance obligation is defined in this paper as a promise in a contract with a customer to transfer an asset. Now, remember, that asset could be either a good or a service to that customer. So in that sense, we're talking about something that's quite similar to the way we look at the revenue recognition process today. As I've also noted before, but it's important to think and remind you here that the performance obligation may be explicit. It may have been mentioned and noted in the contract. Could be implicit because it's the result of practice, Or, as noted before, it could be the result of local laws, for example. Now, one very important issue, again, that's not discussed in great detail in this discussion paper, and I think needs to be considered much more carefully, is what happens when these promised assets are transferred at different times. Because if they're all transferred at the same point in time, the revenue recognition process or the principle applies rather easily. The problem occurs when the different obligations promised within a contract or a group of contracts are going to be transferred at different points in time. And that's where the performance obligations then will have to be accounted for separately, and that's where I believe that measurement is going to be a very, very important issue. Now, let's think a little bit about when are these assets transferred, and what is the meaning of how do you decide that assets have been transferred? Of course, the process, or rather I should say the approach used in this discussion paper is to say that when the customer controls the resource underlying the promised asset, that's when we think that's when we're going to say the transfer has occurred. Now, to a large extent, this is quite similar to what we think about today. But there are many cases where it's not going to be the same. And because, in a sense, this is the distinction between a transfer of control and a transfer of risks and benefits. There are many accounting standards today that focus on the risks and benefits approach. So that's where it's going to be very important to keep in mind how this new approach works. Some other issues. How does customer acceptance have an impact on the transfer of an asset? Now, those of you who've been working on revenue recognition today under U.S. Gaap, for example, are aware that SAB 104, for example, tells us about this. And you know that customer acceptance can actually be a rather significant problem in terms of revenue recognition. And it affects the timing of revenue recognition and sometimes the amount that you can recognize as well. Customer intent. Now, this paper goes to some lengths to talk about customer intent, and it does tell us that we're not going to use customer intent. And there's a very interesting example that's used where an entity agrees to deliver products X, Y, and Z. And they've already delivered products X and Y, and therefore the performance obligation with respect to those has been completed. Now, product Z has not yet been delivered, and the customer cannot use the products as intended. And that example has been used in the paper to show why customer intent is not an issue in this case. I was looking at it a little bit differently, and I thought that it would be important for us to understand what would happen if after delivery of products X and Y, but prior to the delivery of product Z, no one could use the product as it was specified. What happens then? And I think there's a remaining performance obligation in that case. And that's the kind of thing where you have to be careful when you read this paper. The discussion of customer intent is good as it is, but it only deals with one aspect of the intent argument. And I think it will be very important to keep in mind the other import, in a sense, or the inference that one should derive from the argument about intent. Customer payment. As I noted earlier, the customer payment itself does not have an impact on revenue recognition in this paper. But payment terms the paper allows may help us assess whether the customer has an asset. But I urge you to think about another aspect, and that is, what about the ability of the customer to pay? Right? You remember that in current accounting standards, the ability to pay does have a rather significant impact. And I think that needs to be more clearly discussed as well. Now let's take a look at some other issues in here. In general principle, in terms of performance obligations, the paper discusses the difference between goods and services. And I think it's very important to keep that in mind. Here, for example, we have the issue of goods and services. And goods, in general, transfer at a single point in time, and services, in general, again, are transferred over a period of time. So there's like a sort of a continuous transfer. Now, this is where I urge you to be very careful with the examples. Review them. The house painter, for example, the construction examples that are provided over here, because I think they have implications for the way in which we think about, for example, percentage of completion. So that's something to be very, very careful with respect to. Maybe in a later webcast, subsequent webcast, we'll take a look at some of these examples. Here I simply want to introduce you to the concept.
Tony, I'll interrupt you for a second. Just remind our audience to feel free to submit questions at any time. I continue to look at those, and we may have time for some, but hopefully we'll have for as many as possible. And keep your volume up, Tony. That's
okay. Well, that's always a helpful reminder. Thank you, Bob. Okay, so the goods and services issue, I just want to mention that please keep in mind that the contrast is between accounting for completed performance versus proportional performance. And the impact of this paper on the accounting standards of proportional performance is something that we have to be very careful about. Now, if you'll take a look at the slide we have, there's also the issue of a rebuttable presumption that when an asset is used to satisfy another performance obligation in the contract and is not transferred to a customer until the asset is actually used in satisfying that performance obligation. So there we'll have to be careful in analyzing the contract terms or whether there are legal issues, law, for example, rather not legal issues, but law itself that would rebut that presumption. Now let's spend a few minutes on measurement issues. Of course, since revenue recognition in this proposal depends on the net contract position, obviously measurement of performance obligations and the rights in the contract are going to be very important. Now, there is a recognition that performance obligations, because they're non-monetary in nature, will be more difficult to measure because rights are often in fixed and monetary amounts, which makes it somewhat easier. Although whether measurement of monetary amounts is always easy is questionable, and certainly in the light of what's been happening the last year and a half or so, that's something to keep in mind. Now, please keep in mind that here the board has not yet opined with respect to its preliminary views on measurement rights, although they do say that a transaction price would be a good starting point. What's the objective, then, of the performance measurement? And that clearly, of course, is the objective would be measurement of contractual performance during the reporting period. And then, of course, the obligation to transfer goods and services at each financial statement date. Now, from the perspective of a user, this objective, the measurement, the process of measurement, will have an enormous impact on the amount and timing. And my concern here in this paper is that it affects the timing of revenue recognition. And it's not clear to me that timing of revenue recognition is going to be as carefully and consistently measured and reported as it is currently. And that's something that I intend to develop further, that argument, but that's something I want you to think about. Now, the board, of course, has looked at two different approaches. One is looking at current exit prices, which would be in keeping with the definition of fair value in FAS 157 and other and related international accounting standards. Of course, it's clear that that's under assault at the moment, but at the same time, current exit prices would certainly be one way to look at it. And I certainly strongly believe that that would be a better way to look at it. The second approach is the original transaction prices. Now, the exit price approach has been rejected largely because of concerns that it would result in front-loading of revenues, and also the fact that with respect to performance obligations, those exit prices are rarely observable. And, of course, then there's the risk of error in terms of the measurement. Now, one could argue that we do a lot of measurement in financial reporting. A lot of that measurement is based on estimates and assumptions and so on. So the question is, would the risk of error have been significantly higher? And, of course, the presumption here is that it would be, and therefore we're not using, or at least at the moment, we're not using that. Now, the board also then says that the boards have said that they would prefer the use of the original transaction price. And that would be because of the way the pattern of revenue recognition, and it would relate or limit itself to the goods and services to be provided under the contract. The transaction price, of course, is observable, which is a significant advantage over exit prices, which are not necessarily going to be available for many performance obligations. The problem, of course, is the issues of over and understatement with respect to different points in time. So the transaction prices clearly can also present some problems. And this is, again, where I think the use of the transaction price, and particularly when we're going to talk about that in just a moment, how that transaction price is allocated to different deliverables is going, or different, rather, I should say, performance obligations within the contract. And I think that's going to be a very, very important issue. And it's that allocation process that will effectively have implications for the timing of revenue recognition. Okay. Other points or comments with respect to the measurement. Now, when the transfer of promised goods and services is going to occur at different points in time, of course, we're going to need allocation. And the allocation is effectively going to be in terms of the original transaction price, which will normally be a single price. That'll have to be allocated to each of the identified performance obligations at contract inception. And as each performance obligation is satisfied, obviously the net contract position will increase. Revenue will have to be recognized in the amount that was allocated to the performance obligation that's been satisfied. So what's going to happen is that we're going to need to ensure that the remaining performance obligations then are correctly measured at each point in time. The transaction price then is expected to be allocated to each performance obligation in proportion to the standalone selling price of the promised goods and services. Now, what is the standalone selling price? So that's the price at which the entity would have sold that good or service separately at contract inception. And, of course, the paper tells us that actual sales are the best evidence. Now, when you think about this, you can actually think of some very interesting problems that come up, and those are issues that the boards will have to deal with. For example, what if a particular performance obligation is never sold separately? Right? In other words, it's always sold in a bundled fashion. This is a problem that we have today. How are we going to deal with that? What if we don't have standalone selling prices? Then, of course, we're going to, the paper suggests we should use estimated selling prices when no entity-specific or third-party evidence of such prices is available. Now, for those of you who follow accounting processes and standards, you'll probably have recognized this as having been a very big issue urge you all to follow EITF 0801 very carefully, and in particular, pay attention to what's going to happen at the next EITF meeting on the 19th of March, and take a look at, if you have not already done so, please take a look at EITF 0801. Now, I'm going to tell you more about that in just a bit. Some other comments. The boards have not prescribed or proscribed any specific methodologies for estimating selling prices yet. By the same token, the amount of information that we have in EITF 081 is also not rather significant. There's a little bit of it, but there's not enough in there yet. The two examples that have been considered, expected cost plus a margin and an adjusted market assessment approach. Now, I urge you to take a look at the discussion around the description and the discussion around these two, but there are some very important questions. Will these approaches, either of them, actually improve comparability and understandability? Is it actually likely that we can get sufficient disclosures that will allow us to understand what companies have done? And in fact, I'm going to question whether we'll be able to understand it over time for the same company. So will there be comparability across, between companies? Are we going to have consistency from one time period to another within companies? In other words, there are some very significant issues here, and we have to keep those in mind because audit processes will have to be developed, preparers will have to be concerned about these. Now, the concept of remeasurement is discussed. In the interest of answering some of your questions, I'm actually going to leave the remeasurement out. And just remind you, please take a look at that. Also, please take a look at some of these other issues that I've noted here on this slide. There are some very, very important issues that remain to be discussed. As I said, this is a preliminary paper, and it does discuss a concept based on contracts, but there are lots of different questions that we'll have to keep in mind.
On the other issues, Tony, why don't you take a minute to do that? I think I have a plan on how to end on time, but also get some questions in if our audience is okay with that. But on the other issues to be determined, that would be helpful to get some insight.
I think, for example, one of the most important issues is how will the scope be determined, and what will it exclude? And what is the basis for the exclusion? Insurance, for example, the paper tells us there's a board's project on there. Financial instruments, because they present various types of issues. Are we going to do the same with respect to leasing? What's going to happen with lease accounting, particularly, of course, lessor, because that's where revenue recognition comes in. And I think that certain obligations, the actual identification of different performance obligations, and the actual understanding of when those performance obligations are satisfied, how that timing affects. So, in other words, we're going to need a fair amount of application guidance. How does that fit with the objective of providing principles-based standards? And how much of the application is going to be necessary? And I think when you start with a new accounting standard and make such an enormous change in it, it requires a significant amount of application guidance. Measurement, I think, is another area that's significant, and clearly much work remains to be done there. Onerous contracts. But not only that, presentation and disclosure, which clearly at this point in time there's no discussion or very little discussion of those. But I think that disclosure, for example, clearly showing my bent, which is that of, as I've said, of a user, I think disclosures are going to be very critical, particularly because we're talking about using an accounting method for measurement which relies so much on internal information, which I think managers are going to be unwilling to provide much information about. Okay. Then the only other thing I wanted to mention is the last two slides will give you an idea of some of the seminars that I'm offering over the next 3 months. So do please take a look. I look forward to seeing you at these. As you'll see, There are some seminars coming up on EITF 081 and some of the new issues with respect to securitization, changes with variable interest entity accounting, and, of course, software revenue recognition. It's yours, Bob.
Tony, some questions about when versus as. It looks like here that we're moving from when the earnings process is completed to more like as the earnings process is as it progresses. Is that a fair statement, or do you see it differently?
Well, there's certainly a very important question about how timing of revenue recognition is going to be affected. And it does seem to me that there will be some very important problems and issues to be resolved with respect to timing. So whether it really boils down to as will be a function of how much clarity we can get on the meaning of the satisfaction of a performance obligation. Right now, I don't think it's as clear as it should be.
Okay. A lot of questions, as you imagine, about fair value. So maybe 50 to 100. Just I'm going to throw a couple together, and then you can just kind of address them in total. So the idea of cost plus margin or other non-vendor specific evidence and versus the whole idea of as we know it today about VSOE, now the original transaction process and price and how it's different from VSOE. Some people feel that, okay, now that they've gotten it right, isn't this just very subjective and just could be go back to the pre-VSOE days when things were kind of wild? To quote the question, the wild, whatever.
Yeah. Well, I guess they were careful not to say Wild West.
Yes.
Well, that actually is the fundamental question as to when you move to an estimated selling price, there is no question that there's greater subjectivity. The interesting point I think that we should keep in mind is that how does one develop VSOE? And strictly speaking, in a sense, VSOE is a function of the price at which you normally sell something. But it does add an additional argument, and that is the price at which you've actually sold something. And the concern that's being expressed in these questions is that an estimated selling price need not be the price at which you normally sell something. And because it's not necessarily the price at which you sell something, effectively what happens is the question becomes how much subjectivity is there, and how much violence does that do to the issue of amount and timing of revenue recognition. And my concern is that, whether we go back to the pre-97-2 days and whether it brings us to that same wildness or not, the problem I have is how much of an impact does this have on the timing of revenue recognition? And if it makes the timing unreliable, what have I gained? And that's not only from the perspective of a user. I think that management has to be very, very careful about this too, because if management does not get good information about when they've actually earned revenue, will it still be possible for them to make the right capital allocation decisions, the right management decisions? So it is a worrisome problem.
Sure. So I'm going to remind people that the URL is up there, and you can feel free to go there and answer the questionnaire, and that'll allow you to receive all that you need to receive. We're just going to continue for a few more minutes with questions. Tony, you mentioned about the implementation being a few years out. Many of our customers sell multi-year contracts and deliver over that period of time. And any thought being given to how things might happen for agreements that cross over the implementation year? Will they be grandfathered, or will we have to switch midstream? And has anybody been thinking about that?
Well, I think the first point is that with respect to this discussion paper, no, it hasn't. But I think, to be fair, it's early for this discussion paper to be thinking about those things. One sort of guideline that I can provide is please take a look at what's going to happen with EITF 0801. Because there we're talking about, potentially switching to the use of under certain circumstances, estimated selling prices. So the question is, will it be applicable to all the contracts that you have? When does it start? And when does it become effective? And so on. Maybe what we do in 081 at the EITF will be a good guideline to what's going to happen with your type of issue. But at the moment, it's too early to say.
And he talks about concessions, Tony. Many customers, and we've spent a lot of time on this with you, on companies that have a history of concessions on contracts and obligations. Any discussions about that?
Again, I think it's it's early at this point, but clearly the impact of concessions on performance obligations, and particularly on measurement, is going to be a very big issue. And I really hope that that's one of the application guidance areas that we do hear something about. But strictly speaking, at the moment, there's not that much on it.
Okay. So your comments, if we got this right, you said you prefer the exit approach on the measurement, which was been rejected. Can you clarify either your position or their position?
Okay. I can, certainly do both. The paper tells us that they're concerned about the exit price for a very good reason, and that is it's very difficult to get exit prices for many of these performance obligations. Now, what's happening, of course, in the marketplace today is that we have a version of an exit price, sort of, in 97-2 when you think about VSOE of fair value. But there are many industries where they don't have to worry about those. Now, of course, when there are multiple elements, then EITF 0021 required some information about it, and you had to provide fair value information there, or use fair value information there. But that concept, although similar to VSOE, was not stated quite that way. EITF 081 changes that largely and says that under specific circumstances, when you don't have VSOE, for example, and you don't have third-party evidence, you switch, you will be able to use estimated selling prices. And as I said, my concern with estimated selling prices is the subjectivity of it. It's not clear to me that the allocation is going to work out. It's not clear to me that the timing works. So those are some concerns that I have with respect to subjectivity, with respect to the subjectivity inherent in the estimated selling prices. Is it insurmountable? No, I don't believe so, but we'll have to wait and see how that works out. My preference for fair value and for exit prices is of long-standing, and for one very simple reason. I believe very strongly that people make decisions in terms of exit prices. And I think because we make decisions that matter to us in terms of exit prices, that's always been the right approach for measurement in financial reporting.
We always like to give you a crystal ball question, so here's the one for today. Do you see the U.S. Gaap Rev Rec standards moving towards the current IFRS standards or vice versa?
Well, the first thing is that that's a very dangerous issue simply because there are so many places, so many issues where the IFRS does not have revenue recognition guidance. So I think that if you say that we're going to move to the IFRS, you might find that, many foreign companies are actually using U.S. revenue recognition guidance.
Right.
So there, if you then eliminate U.S. GAAP, I think you end up in a place where I don't know that too many of us want to be, because there isn't any guidance there. Software is a very interesting, a very important example. I think multiple element accounting standards are a very important example. Very little in the IFRS on those. I think it's very, very difficult at times to tell what a foreign company is doing with respect to those issues. Sometimes they tell us that they're using, or you can tell that they're using U.S. GAAP. But then the question is, to what extent are they using U.S. GAAP? And my additional concern there is that, if you think about how many companies in the U.S. have had to restate, and how many people seem to have trouble with U.S. GAAP, I just think that when a foreign company uses it, there are two problems. Both it's not clear how well the preparers themselves have understood U.S. GAAP, and it's not clear to what extent the auditors there are emphasizing or have procedures that will allow them to look at and to review those processes. So it's a very, very difficult issue. And in that sense, I think one should root for this revenue recognition project to come up with something useful and a good answer, because then both IFRS and U.S. GAAP would be moving towards a better answer.
Okay. We had some logistical questions. People asked where they get a copy of the discussion paper. I understand that was sent as part of the email invitation, and the best way for them, Tony, to follow along and make comments is?
I think the best thing to do is to go to either the IASB or the FASB websites, okay. Pick up the paper, and then send your comments to one of those two. Don't send them to both. It's not necessary. They're going to share these. But I would definitely do that. And then the other thing I'd recommend is please keep an eye open to discussions, because both boards will be telling us of their progress. And that's very important. Keep that. And, of course, you can always come back to the next webcast.
Right. There you go. Advertising that we'll be back at this again. So thank you for those who stuck with us. Again, if you look at your screen, our survey is at www.softrax.com/webcast-survey. And, again, we appreciate your feedback on that. Thank you, Tony, for sharing your comments and insight on this developing topic, and we will continue to come at it again when we feel necessary. Thank you for all the attendees for your time, and in fact extra time, and your questions. I'm sorry we couldn't get to them all, and please stay tuned to your email and revenuerecognition.com and SOFTRAX.com for future events such as this. So thank you very much, Tony.
Thanks, Bob.
Bye-bye now.